Hi, my name's Josh Mahony, Chief Market Analyst at Scope Markets. I wanted to give you a preview for the upcoming US inflation report coming out on Tuesday, the 13th of February. It's going to be a big ticket item and driver of volatility over the course of the week as we see a repricing around about expectations for the Federal Reserve. So I wanted to give you a wider outlook of exactly what we're expecting for this report, what I think might actually happen despite expectations, and whether we think we should listen to it or not. Is it going to be notable? Is it something we can essentially look beyond? Is the Federal Reserve going to look beyond it? Well, these are all different things that I'll look into. Remember, if you like these videos, hit that like button and follow us. We're trying to grow the channel, so that would be much appreciated. So first and foremost, I wanted to show you market expectations according to Trading Economics, and we're relatively early in this, so things might shift a little bit. But we're expecting to see that headline number remain steady at 3.4%, and then core inflation move lower down to 3.7% from 3.9%. The monthly metric, 0.2%, so a decline on that headline number. And then the core reading expected to come in at 0.3%, same as the prior month. However, if we look into the nuts and bolts of it, what we're looking at here is from a headline inflation perspective, the stripping out of that 0.517 reading from January last year and replacing it with something that by and large is likely to be lower than that. I mean, if you look at the past 4 months, all of them have been sub 0.5%, even the highest, which is 0.4%, which was that September reading. Last month, we did see that 0.3 reading. Prior to that, we saw a couple of relatively low numbers. So are we looking for a reading significantly below 0.517? I would say so. So we could see a move lower in terms of that headline rate. But the caveat here is that if we're looking for future decreases, it's going to be more difficult because the January figure from last year is the highest number that's going to be stripped out for something like 7 months now. Look, the next time we see a really big number stripped out is August, and that really is the problem in terms of driving this headline number back down to target. If you look over the course of the past 5 months, we've got 1.3% inflation tied up in August, September, and December. So, we have got a couple of really low numbers in October and November, which is certainly welcome. But until we see August and September stripped out, I just don't think we're hitting target. And that is highlighted by the lower section here. I've annualized out the 6-month readings, the 8 months, the 10 months. And essentially that means that, if you look at the past 6 months and you look at how the pace we're moving at over the last 6 months, where would we be in 6 months' time? Well, we'd be at 3.3. 8 months would be at 2.95, the 10-month reading 2.87. None of them actually get anywhere near that 2% target. And arguably, you're probably only going to see it if I annualize maybe out the 4 months, but certainly the 3 months, because we've been seeing some very low numbers in October and November. So that really points towards the idea that it's only really the back end of the year that we're likely to see inflation hit target. Remember, if we see that August reading stripped out, well, we're probably going to see it stripped out in September. So, when we see September stripped out, that's October. We're looking at the last bit of the year, and you can see why we're starting to see some of these Federal Reserve members really pushing back on the idea that we're going to see previously 7 rate cuts for this year. It just wasn't going to happen. Now markets are pricing 5. Well, we're seeing them push back on that as well. So headline inflation, I do think there's a good chance that we move lower, but that shouldn't necessarily be celebrated as like, right, we're back on track to move straight back down to 2%, because I just don't think it's happening in the next 7-8 months. In terms of the core readings, this really highlights the fact that there's a big differential between the core PCE metric and the core CPI metric. Core PCE is favored by the Federal Reserve. It is a wider reaching and wider spanning metric. It is also one that is updated more frequently to account for the real life costs that people are undergoing in the US economy. So I would say that whilst the core CPI number is likely to be followed by the markets and they would react to any significant moves in it, the core PCE number is more important, and that is what the Federal Reserve attach greater importance to. Now, this is where we could potentially see the Federal Reserve taking a bit more of a dovish stance, because the core PCE, which is not released on the 13th, is currently on track to hit that 2% target if you look at the 6-month annualized. So the past 6 months have actually put us onto a trajectory for hitting target. And in actual fact, it might come sometime a little bit before that. So the core PCE metric does give us an idea of, well, the Federal Reserve might opt in an election year. So they might have some pressure from Janet Yellen. They might opt to try and move a little bit ahead of time and say, well, look, we don't have control of food prices and energy prices, but the underlying inflation, which is measured by the core PCE number, is moving back down towards target. So that, I think, is going to be really interesting as we move forward. In terms of the outlook for interest rates, I wanted to highlight a couple of things. First and foremost, I wanted to highlight the fact that we've seen this significant repricing away from a March rate cut and towards a May rate cut. You can see the right-hand section of this chart highlights how we've certainly from a month ago to where we are now seen this massive swing away from what was previously anticipated to be a rate cut and towards what is essentially a rate hold. So now over 80% expectations for a rate hold. And then in terms of the timing, there's that. So now markets looking towards May as the first rate cut. And then there's the degree to which we're going to see interest rates cut. So we're seeing a repricing away from, at its extremities, 7 rate cuts and towards something more like 5 and more like 4. And I think that's likely to be dragged in over time because we're seeing commentary from Jerome Powell and other members of the Federal Reserve and the FOMC coming out and saying, well, I only expect to see 3 rate cuts. I only expect to see 2 rate cuts. And as we saw previously, for a long period of time, the comments coming out from a number of the Fed members were essentially falling on deaf ears, and markets didn't really care. They still just believed, right, we're going to see 6 rate cuts. We're going to see a rate cut in March, and then we're going to see a rate cut every single meeting from there on in throughout the entire year. And that has started to be reined in to the detriment to an extent of markets, but I would say to the benefit of the US dollar. And so I wanted to highlight exactly that and talk around that. So first and foremost, we're looking at the US dollar here, and I'm pointing towards the idea that we could see further repricing for rate cuts away from, maybe not as much away from May, but potentially away from May into further down the line. But the timing and the scale of those rate cuts really, I think, are going to continue to come into focus. If we do see that, then it should come as a benefit for the US dollar. Now, we're starting to weaken a little bit heading into the back end of this week. I'm recording this on the 7th. So we're hoping to see the potential for further downside. And we could possibly see further downside if we see this inflation metric moving lower. Like I said, I think there's a good chance we do see some disinflation for both core and headline inflation this time around. But I don't necessarily think that changes the wider landscape. Like I've said, I've highlighted the fact that the long-term picture does get us back to target. But unless you're only looking at core PCE and that's the only thing you care about, the CPI numbers don't get back to target particularly soon. And so that could give us further upside for the US dollar. So near term, we could see some downside. And if we're looking around that inflation gauge, inflation reading, if we see it move lower, then, for the time being, people might think, great, we're heading in the right direction. We're moving lower once again. But the wider picture does likely cause concern for the Federal Reserve. And that, as we've seen recently, is likely to bring further commentary around the idea that we're getting a little bit carried away with ourselves still, despite the repricing that we've seen of late, which comes to the benefit of the US dollar. If you look at price action over recent periods, we have seen, let's see here, this rally, consolidation, rally into the 61.8, consolidation, rally. I think maybe there's a good chance that what we see here is another consolidation phase before we likely move higher once again. I think there's further repricing to be had, and that could come to the benefit of the US dollar and to the detriment of other assets such as gold and silver and Bitcoin. Bitcoin actually has been holding up very well because everyone's getting very excited because we're approaching that halving event, which is about 2 months out now. And that should really form the basis for, certainly if you're looking at historical trends, a particularly strong year ahead for cryptocurrencies. Nonetheless, if we're looking in terms of precious metals, gold we have here attempted that breakout, but really faltered that long upper shadow, giving us that sell-off that we saw last month. This is the monthly chart. This is the weekly chart. In the daily, we can see here we're sort of in consolidation mode at the moment. If we see further upside in terms of the US dollar, which I think is possible for the near term, then that could come to the detriment of gold. I don't necessarily think that we're going to see a massive sell-off, because I do think that the long-term picture still does see interest rates moving lower. That comes to the benefit of precious metals. And so I think that we're likely to see, consolidation more dominating, some downside, but not necessarily a huge amount of it. I mean, look, if we were to overlay the likes of the dollar index onto this chart on a new scale, and then we're going to want to invert it. Let's go. There you go. So what you can see here is that we're seeing a much more significant decline in the US dollar than we're seeing selling pressure for gold. So it's holding up relatively well despite the move we're seeing for the US dollar. I think there is a good chance that we see further upside for the US dollar, but I don't think we're going to see as much downside for gold as we would upside for the US dollar, but certainly worth looking out for. And then in terms of US indices, really, this is predominantly being driven by big tech recently. A lot of the other companies within the sector haven't necessarily been moving that far. But nonetheless, the trend is your friend. And the trend, as things stand, is a bullish one for the S&P 500 as we look, let's see here, as we push into record highs once again today. So unless we start breaking, let's say 49.16 level and alike, and 48.40, that starts looking like we're going to roll over. But until that happens, we remain within a bullish trend, and therefore any sort of risk-off move that might come around a announcement, any commentary from the Federal Reserve that we might be getting a bit carried away with ourselves on the rate cut front in terms of market expectations. I don't necessarily think that's going to have a huge impact unless we see tech stocks roll over. And at the moment, that's not necessarily happening. From a wider perspective, we've seen Meta in particular doing particularly well out of this earnings season. And everything seems to be hunky-dory if you look at the direction of this chart at the moment. The trend is your friend, and it remains a bullish one. And so I would expect to see more of the same unless we see some of these key support levels taken out.